Hi class, I hope you all are doing well. Well, we've made a lot of progress so far, so let's just get right into it. Some of the things I'd like to cover for today's video include a real quick recap of some of the basics with respect to journal entries, moving over to T accounts and the trial balances. After we spend just a moment with that, I'd like to touch on adjusting entries, what we dealt with this last week. I'd do a quick preview of next week and then spend a little bit of time on financial statements. Okay, recapping last week, some of this will be a little superfluous for those of you who have become really familiar with the material, but it might be a good review for numerous others. This spreadsheet that you're looking at right here is something I showed you last week, but just to recap, this is a journal entry and so is this a journal entry. This first journal entry, we're using cash to pay for the utilities expense. Cash is being credited because it's being reduced, and then the utilities expense is being recorded. That's a debit transaction. Both the credit and the debit for each journal entry is always posted to a T account. So the utilities expense right here, we look at the utilities expense, that is a debit entry that gets reflected on the debit side of the T account right there, entered into there. One thing I think most of you remembered, but maybe a few of you forgot, and it can be tricky or it can mess everything up if you don't remember to do so. Look at this right here. The first thing we have to do on the T account before we enter the current activity balance is start entering that from your more recent journal entries is to make sure that the previous balance is entered into there. See, on this cash account right here, we have a PB or a previous balance of $20,000. If that's not entered into there, obviously your summations and your current balance at the end are going to be wrong. So enter that into here. If these entries right here reflect journal entries for June activity, what we have to do before we put that June activity down in here is we have to enter the May ending or the May 31 ending balance in here first. And so that'll make everything else work. Okay, moving back to that other spreadsheet. Okay, they're posted there, and then these T accounts are summed out. This obviously has a debit balance here, and then this one right here, there's more debits than credits, so that's going to have the cash right there is going to have a final debit balance, as do all assets that have any positive value. And one thing our text says I think is really helpful, and when we move along to the trial balance, because these final balances, the current balances and the T accounts are what are reflected in the trial balance. And our text says the current listing of accounts is referred to as a trial balance. Since T account are kept together in a general ledger, a trial balance reports the individual balances for each T account maintained in the company's ledger. Now, if no, see right here, just make sure you see this. Cash right here has a debit balance as you would expect. You know, go right to here. That final current balance is what's entered in the trial balance. Same with the common stock. That's a credit balance, as common stock has to have a credit balance if it's a positive amount. That's entered into there, and then they're summed out, they equal. So if we don't skip any steps with the journal entries, posted to the T accounts, making sure we enter the previous balance first, and then those current balances reflected into the trial balance. The trial balance will be accurate and it will balance out. So hopefully that was helpful. Okay, before we look ahead to financial statements or even preview next week, let's briefly touch on adjusting entries, what we dealt with this last week. Okay, this first adjusting entry right here, remember we pay utilities probably once a month, and it's not going to line up exactly with the month end. It'll be at some random date throughout the course of the month. And if we're going to report the financials at the end of the month, we want to make those adjusting entries to reflect the activity that's taken place since then, even if no official transaction has taken place, because a large property is going to burn through a lot of utilities expense. And so if we're not making that adjusting entry at the end of the month, it's going to reflect inaccurate financial information. So this one right here, every day a utilities expense is being incurred, and then at the same time when that utilities expense is being incurred, even though we're not paying the bill, our obligation to pay that bill is increasing. So that liability, and liabilities are whenever they have a positive balance, they're a credit balance. So our adjusting entry is going to reflect a debit to the expense as we do when we expense things, and at the same time we're increasing that liability, and that's going to be a credit. They're equal amounts, as are all journal entries. Also, one thing to bear in mind too is, just to remind you, we talked about on adjusting entries, there's going to be an income statement account and a balance sheet account affected. Here, as you see, an income statement account above and a balance sheet account below, and so both are impacted. One final example, here we have a company that had $4,000 in prepaid rent expense, so that's an asset on their balance sheet. Now a month passes by and they owe another month's rent. They don't have to pay anymore since they already have 4 months. It's $1,000 per month, so they have $4,000 prepaid. So as one more month passes by, they'll owe 1 month's rent, $1,000, and at the same time they'll have to reduce that prepaid asset, the prepaid rent of $4,000 down to $3,000. So how do they do that? Debit the rent expense here, credit the asset by the same amount. So we're reducing that prepaid rent asset and we're expensing the rent which is come due. Again, here we dealt with an income statement account, and here a balance sheet account. We could go through a bunch more of these, but I think that's sufficient for now. And this week we will be dealing with chapters 7, 8, and 9. Chapter 7 focuses on receivables, chapter 8 inventory, and chapter 9 cost flow assumptions for reporting inventory. In other words, how do we price or determine the cost of goods sold if we pay different prices for certain inventory items at different dates? So check out these PowerPoint presentations. I think most of you have been, but they can be really helpful in conceptualizing and developing your understanding of these new concepts. So I think they'll be helpful, as will the graphics, some of which we looked at from previous chapters just now in this video. I think they will also prove quite helpful. You know, looking at that sort of stuff was important to me as I was studying this subject matter. That, along with the actual text, the words in the textbook, work together really well. So I wanted to draw your attention to those of you who haven't yet made much use of them. The last thing we're going to do today is take a look at financial statements. The most common among these are the income statement, the balance sheet, and the statement of cash flows, which you've already been examining or exploring a little bit so far, starting in chapter 3 and working on this last week in your homework. It should note, however, that the statement of cash flows won't be fully explored until later on in the textbook. However, that statement of cash flows is super critical because positive net cash flow is a very important indicator of a company's health. Aside from the fact that a company needs cash to perform its operations, it's possible that a new growing company could have positive earnings, may have negative earnings, but it could have positive earnings and at the same time negative cash flow. That is typical because it is requiring more cash to grow, and it is investing more cash than it is generating. You know, think of Tesla. Tesla's burning through a lot of cash right now, and its investors are willing to accept that negative cash flow in the short period, negative cash flow from operations in the short run, with the expectation of large cash flows in the future. Remember that investing is not an expense, it's what they call a capital expenditure. It is exchanging one asset on the balance sheet, cash, in exchange for other assets, usually property, plant, and equipment. You can finance, you know, the investments, but for now we'll just think about the example of using cash to purchase that property, plant, and equipment with the expectation to generate more revenues in the future and more cash flow in the future. One of the things that's important about the cash flow statement is that it's possible that a company's income statement reflects positive earnings, yet because of what they call a poor quality of earnings or other various reasons, it may still not be a healthy company, and a reduced or negative cash flow might be an indicator that that is the case. On the screen here today, this workbook is a financial model of CVS, It has more information than we need, so I will limit our examination of it until certain portions. However, you'll notice in the top here the years. In 2000 to 2002 are the historical data. 2003 to 2006 are forward estimates. Ignore the forward estimates for now, but it's still kind of interesting to see, so I let you take a glimpse at this model, but we'll take a look at some of the other portions. This workbook has numerous financial statements on each of these tabs here at the bottom. We're looking at the income statement, or the top part of the income statement. Here's the balance sheet. Here's the statement of cash flows. Okay, moving along. It is important for you to note that there's a relationship between each of these statements. For example, each year a company's earnings minus the dividends it pays out are closed into the retained earnings account. Now, the income is shown on the income statement, and then the retained earnings is on the balance sheet. So you're seeing a relationship already between the income statement and the balance sheet. If we were preparing these financial statements mid-year, the earnings year to date would be added to the equity, or reflected in the equity portion on the balance sheet, in order for the balance sheet to balance. Also, when preparing the statement of cash flows, the first part of it, I'll move to that. The first part of it is cash flow from operations, and the first line on the cash flow from operations is net earnings. You'll see here in the year 2000, it's $746 million. And where do we get that from? The income statement right here, in the year 2000, 746. So this item right here flows into the statement of cash flow. However, we may need to make adjustments for that on the statement of cash flow, because when we're calculating earnings, one of the expenses included in that is depreciation. Don't worry if you're not following along with what I'm about to say, but depreciation is a non-cash expense. So since we're trying to figure out exactly what the cash generated from the business is, we're going to add back from that earnings amount non-cash expenses such as depreciation. So that's one of the things that we do there. But anyway, this is just an introduction and just a peek ahead, so don't worry if you're not following along with that part of this video. I do want you to understand, however, that there is a relationship between these statements and that they impact one another. Even, for example, looking at the balance sheet. We'll take a quick look at the balance sheet. There's what they call interest-bearing debt. Interest-bearing debt is debt that you have to pay interest on. Well, that interest expense is shown on the income statement. So the interest-bearing debt on the balance sheet directly impacts the interest expense shown on the income statement. So again, there's a relationship between the balance sheet and the income statement, and then, as we talked about before, the income statement feeds into the statement of cash flow. So there's a dynamic relationship, some dynamic interactions between all of these statements, and that's pretty interesting, I think, and they all work together. Some of this, what we did today was for review. Some of it was a look ahead, and some of it was simply intended to show you what can be done with accounting, how it relates to finance, and a little bit just to whet your appetite for more study in finance and accounting. Well, we've covered a lot. Let's good luck with the work ahead this week, and if you have any questions, feel free to reach out to me. Take care. We'll talk to you next time.